Hello, everybody. Good morning, good afternoon. Welcome to the sixth part of our Raising Non-dilutive Capital series. Today, we will talk about venture debt, what it is, why it is useful, and how to find it. Venture debt is a catch-all term referring to loans that are tailored to the needs and the risks associated with investor-backed startup companies in technology. Unlike traditional loans that focus on historical cash flow or working capital assets as a source of repayment, venture debt emphasizes the borrower's ability to raise additional capital to fund growth and repay debt. As a result, lenders consider a differentiated set of risk metrics to evaluate companies. It might also include terms that allow them to convert part of the debt to equity in order to participate in the upside of the company or protect against loss. I'm Sebastián Molina Gassman, and I am an investment manager at SeedStars. And today, we have two panelists who I will introduce shortly who are experts on the topic and active investors. Before we start, you might know a bit about SeedStars, or you might not. Um, so I wanted to quickly walk you through what we do. As a group, SeedStars can be divided into two areas. On the one hand, we have SeedStars Community, where our goal is to accelerate technology and startup ecosystems in emerging markets through differentiated partnerships and initiatives, which include early initiatives like hackathons and acceleration programs, all the way to cross-border and cross-regional expansion programs. On the other side, we have SeedStars Capital. We're an early-stage investor in high-growth technology companies. To date, we have 75 companies in our portfolio across 32 countries around the world. Working with our portfolio companies, we have found that a lot of these startups benefit from debt or non-dilutive capital. However, there are often a lot of misconceptions or questions around the process of obtaining this type of financing. As a result, we wanted to showcase the different types of non-dilutive capital available for startups and created this 7-part series in which we talk to experts on all the different types of non-dilutive financing available. Today, I'm honored to welcome two panelists who are experienced in the field of venture debt. First, we will chat with Gina Bay, managing partner at Abound Capital. And afterwards, we will have the opportunity to talk to Andrea Weather, co-founder and chief business officer of A55. These two investors utilize very different models with one common goal: provide capital to technology companies so they can continue expanding their operations. They will give us their perspective on this model, as well as provide useful information for any entrepreneur for whom this type of financing might be a good fit. With that in mind, I would like to invite Gina to join me.
Hi, everyone.
Hey, Gina.
Hi.
Great to have you here.
Thank you.
Everyone, Gina is a co-founder and managing partner of Abound Capital, a venture debt firm committed to expanding access to capital for entrepreneurs in the emerging markets of Southeast and South Asia. Gina, I'm incredibly excited to have you here today with us. Can you please tell us a bit more about Abound Capital and the work you're doing in Asia?
Sure, absolutely. It's really nice to meet you, everyone. And as Sebastian just introduced us very nicely, Abound Capital is a venture debt fund established in Singapore with the mission to expand access to alternative capital for entrepreneurs, startups, and SMEs in Southeast and South Asia. So to give you some background and context for venture capital and venture debt ecosystem in emerging Asia, the developing economies of Southeast Asia and South Asia within our investment mandate have a combined GDP of $3.6 trillion. And it's growing consistently, really bolstered by the strong macroeconomic drivers. And the region's internet economy is actually also growing really fast. It's currently about a $100 billion economy and projected to grow 3x to about $300 billion in the next 5 years, which is really exciting for us. The venture ecosystem is about 10 years old, but venture debt, however, is still in the nascent stages of growth. We have seen an increasing number of entrepreneurs seeking venture debt as an alternative source of capital that really best aligns with their growth strategy. And venture debt allows you to extend cash runway while reducing cost of capital and minimizing dilution. So we can discuss the benefits of venture debt in more detail shortly. But before we do that, I'll just quickly introduce ourselves. Yeah, no, so I think, as I mentioned, we are working with entrepreneurs in Asia's emerging markets. Many early stage companies in this region are in what's called the missing middle, where they're not really eligible for bank loans, and they're also too big to be serviced by the smaller P2P like lenders. And as you might imagine, banks cannot really underwrite for the risks associated with early stage companies that have minimal revenue and have years until they actually turn EBITDA positive. But we believe in these companies, so we decided to support entrepreneurs in alternative sources of capital, and to also provide terms that actually work for them, unlike some banks that actually offer some pretty punitive or aggressive terms, such as personal guarantees and directors' guarantees, which are not really part of how venture debt works. So yeah, we wanted to make this source of funding available to entrepreneurs. Our strategy is to provide debt capital in the form of venture term loans to early stage companies. Our core market is Southeast and South Asia. The largest markets that we serve are Indonesia, Vietnam, and the Philippines. And we typically fund companies at Series A and B stages. So we start meeting with companies after they've raised an institutional round from a leading VC investor. And we like to meet our founders even before they actually need debt funding, so that we can actually build a long-term relationship and partnership with them from early on. And in some cases, on the later end, we also support some Series C companies if they're looking to raise debt as a way to bridge to profitability. In terms of sector, the overarching theme that we have is SME and consumer enablement and empowerment. So some of the core sectors that we focus on are B2B, B2B2C SaaS companies, fintech, retail enablers, healthcare, education, logistics, and supply chain. So it's a pretty broad theme, as you can tell. And in terms of impact, we are actually incorporating impact thesis into our investments, and have 3 priority impact areas that we focus on. The first is diversity and inclusion, with a particular focus on gender lens investing to promote female entrepreneurship in the region. And we also are committed to creating new business and jobs in this region, and also especially through financial inclusion. So we are committed to monitoring the impact of our capital on our portfolio companies, and the social impact that they create in their respective communities. And quickly, as a team, we are former entrepreneurs, industry leaders, and VC investors with decades of experience and extensive founder and investor network in the region. And our goal is really to, in addition to providing capital, we aim to add value in the areas of financial and operational advice, strategic partnerships, and fundraising. And we're headquartered in Singapore, with regional offices to be expanding to many different markets, but particularly Indonesia and Sri Lanka for now. So yeah, I guess we can move on to the next slide, the really meat of the discussion: why venture debt? Why should founders be looking for venture debt? So venture debt is a non-dilutive source of capital to support the growth of venture-backed companies. There are many benefits to venture debt, as you can see on the slide, but I especially want to highlight first that venture debt can minimize dilution. So when you raise equity funding as an early stage entrepreneur, you give up 20-30% of equity at each round. But if you were to actually raise a mix of equity and debt, you can save approximately 5% in equity. So instead of giving away 25% in equity, you would only give up 20%. And I can discuss the details of sort of the terms later, but there is a small warrant component to venture term loans, but it only represents less than 1% dilution in most cases, so it's still very much non-dilutive. And as everybody knows, equity is precious, especially if you believe that your company will do well, right? You don't want to be diluted down to single digits come Series C and D. So it's really important to think about preserving your ownership. And we have seen actually many second or third time entrepreneurs in this region come our way because they have built and scaled and sold the companies. They poured decades into building this company, but they have learned upon exit how precious equity is, and they really want to minimize dilution, especially in the earlier stages where you get diluted the most. The second benefit would be to extend cash runway. So by adding venture debt to your existing or concurrent equity round, you're able to add about 4 to 8 months of cash runway, which could be really valuable because you're able to use this additional capital to achieve more and reach additional milestones before your next round. So this really enables you to raise at a higher valuation. So this is another way that venture debt can actually help you minimize dilution by helping you to raise at a higher valuation for your future rounds. And in terms of the cost of capital, everybody knows that debt is always less expensive than equity. But I guess I do want to point out that venture debt is complementary to venture equity and is not really meant to replace equity funding altogether. In fact, you should be raising both together always, so you can actually maintain a healthy leverage ratio. However, by blending venture debt with equity, you can definitely decrease the overall cost of capital. And in terms of just the uses of venture debt, it is a very flexible source of growth funding and can be used for varying purposes, from balancing working capital to financing inventory, CapEx or acquisitions. But just remember that overarching guideline for the use of venture debt is that it should be tied to revenue generative activities. And I guess this is sort of pertinent to the times that we live in now. But venture debt is particularly useful for times like COVID because it acts as an insurance policy and provides buffer against unforeseen circumstances and delays. And we know that not everything goes exactly according to plan when you're running a startup. It's a dynamic journey. And then the last thing you really want to do is to run out of cash and have to raise an emergency down round, which could be quite challenging. So using venture debt as a buffer can mitigate situations like this. And lastly, venture debt is actually quite fast and a relatively easy add-on to an ongoing equity round. So it can definitely save you time from getting that next equity investor. I guess we can move on to the next slide.
Fantastic. Thank you, Gina.
Mm-hmm. So I just quickly put together some investment criteria and terms to give you a little bit more color on what kind of companies we look for, how we like to work with companies. So broadly speaking, we like to work with companies with strong, consistent, and sustainable growth. And in terms of our investment criteria, I guess we also assess our companies much like a venture capital investor across various criteria such as market potential, market risks, competitive landscape, team management, etc. But because we are a venture lender, we do pay particular attention to assessing sort of the repayment capacity and place strong emphasis on the business model, financials, cash runway at the time of funding, current and future fundraising abilities, and also lastly, fit with debt. So to elaborate a little bit more on the business model side, the companies that we typically work with are revenue generating already and can therefore support some of the payments associated with interest or amortization of the loans. We also do prefer to work with companies that have high quality and predictable revenue. I guess recurring is best from diversified set of customers. And the companies that are really focusing on sustainable growth and hopefully profitability within the next 3 to 5 years. And in terms of fundraising, which is another source of repayment for our loans, we do look at which VCs are part of your board and already an existing investor. So if you're backed by a tier 1 VC, we really analyze sort of your existing investor base and their ability to either follow on or provide value add in terms of your continued fundraising. And in terms of fit with debt, so I guess we do prefer to work with companies with business models that have a natural or strong fit with debt. If you have a strong need for balancing working capital, financing receivables, inventories, where it really makes sense to use debt versus equity is sort of preferred. And I guess if you're actually thinking of making capex investments with assets with collateral value, or expanding or acquiring companies, or I guess kind of like we've seen a lot of aggregators recently that are actually capital intensive, but leads directly to top line growth and predictable cash flows. That's really attractive. And we also come across companies that are not just in fintech, but whether it be education. There are different companies that are sort of branching out into lending and then using sort of venture debt as a lower cost of capital to capitalize on the net interest margin. That's also an interesting business model. Finally, I guess in terms of investment considerations, we do take into account the entrepreneur's commitment to social impact in the way we like to work with them. I guess to delve into the specifics of investment terms. When should you be thinking about venture debt? The timing of it is really when you're raising equity rounds. So you can raise debt as part of your ongoing equity raise, or can add on venture debt up to about 6 months, within 6 months of your closing your equity rounds. So that's sort of the general timeline for when you should be raising debt. In terms of stage, as I mentioned, we work with companies starting at pre-Series A all the way up to post-Series B that are backed by top-tier VCs. So typically the companies that we look at are raising equity rounds of between 3 to 30 million. And our check size actually corresponds to the equity rounds because we care about the leverage ratio. So we believe an appropriate leverage ratio is between 20 to 30%. So we usually take up about 20-30% of the latest equity rounds as a guideline. And our checks are typically between $500,000 to about $4 million, with an average check size of 2 to 2.5 million. And so I guess depending on your burn rate, you can really add on about 4 to 8 months of cash runway by working with debt. In terms of the tenor of our loan, it's a medium-term amortizing loan with tenors between 24 to 36 months. And in terms of interest rate, so there's an interest component and the warrant component. So the interest rate on a flat basis, it's about 5 to 8% per annum, but the effective rate would be about 10 to 15% on a straight line amortization basis. And as I mentioned, we do take warrant positions together with our loans, with the warrant coverage of about 10 to 20% of our loan size. And this usually represents less than 1% dilution for the founders. And we do take warrants because we're taking on the risk of investing in very early stage companies. And we want to be supportive of the company's growth and be aligned with it in the long run as well. I think that's sort of the basics of our investments. I think I'd be happy to take any questions or wait for Q&A session as well.
Fantastic. Thank you, Gina. I really appreciate the insights you shared. I think this is a very clear and practical guide to on venture debt. So thank you for that. And exactly, if we have any questions from the audience, please feel free to put them in the chat. We'll be monitoring it and asking it not only now, but also in the Q&A session in the end with both panelists. But maybe to start, I see Eugenia mentioned is asking, when is a startup ready for venture debt? So maybe the question is, beyond stage and in this racing around, what are some indications that you as a founder can see in your company that might make you think, okay, I am ready to start looking for venture debt?
Sure. So as I mentioned before, one of the requirements is that you are already backed by an institutional investor, preferably a top-tier VC. So I guess if you have to be organized in a way that you're ready for institutional funding or have already been prepared in such a way. So that's definitely number one criteria. Another criteria is when it comes to business model that I mentioned, we do typically work with companies that are already revenue generating, so post-revenue and cash flow generative, so that you're actually able to support some of the payments of interest and the amortization that occurs not just at the end of the tenor of the loan, but it's an amortizing loan. So it's throughout, you have to pay down a certain part of the principal throughout the terms. And I think the last one would be really how how do you foresee, the use of capital that you raise? So does it actually have a specific, are you really raising to fund innovation, like product development, for instance, in which case equity might be better? But, do you have specific needs for venture debt? That could be, if you have receivables and you just need to bridge that, if you're actually fronting some of the inventories and you need debt for that. I think you need to be a little bit, we can definitely help you think through this as well, so that we can become, helpful to you in terms of how you think about thinking about raising debt together with equity. And then lastly, I guess I would mention that you should always be talking to, I guess working with the venture lender is definitely a long-term relationship, much like how it is for you to work with venture capitalists. And you want to be sort of in relationship with, or having started the conversation before you actually need the capital, because you're then always in a better position to, negotiate and, actually, come up with terms that are actually more, that works better for you, right? So yeah, that would be my advice.
That makes tons of sense, and I think that is completely true, right? It's not just about the check itself, but there's also this value add component. So it's also as well really important to see, who the funding team is and where can they add strategic value. And maybe before we change gears, Gina, I'm curious. Could you tell us a little bit more about how long these processes normally take? Maybe from getting in touch with the company for the first time all the way to deploying capital. What does that process look like?
Sure. So I think it kind of has to do with how we come to meet companies. So we typically work with companies and the founders that we have sort of known and supported in other capacities, the founders that we have known personally for a while. I think it's definitely based on trust, how we work together. And also through our VC partners that we like to work with and, provide value add together. So I think that's sort of where we sort of start the journey. In terms of how long the process takes, we typically like to start talking to the founders about 6 months before, just so that we can actually really get to know the team, get to know, how they are delivering against their milestones, and just, also have time for us to get to know the business so that we can provide, like the best and the most flexible terms for the founders, himself or herself. So I think that's when we like to engage. In terms of the actual process, it's not necessarily that you need to prepare separate sets of, due diligence documents for the lender. You can just leverage the work that you're doing with your equity raises. So it's not additional. It's just you can probably leverage the existing materials. And I think the whole process would take about, I guess, 6 to 8 weeks. And I guess the thing about venture debt is that you don't necessarily need to time it perfectly with equity raises. You can always add it on up to 6 months, after your closing. So there's some flexibility with timings.
That's great to know. And yeah, I think a tip about kind of not having to create everything from scratch is super useful, because that might create some apprehension of founders, especially if you just raced around, just went through all these due diligence, you create all these materials, and you think, oh no, I have to start all the way from zero again. So that's fantastic. Well, thank you so much for this presentation, Gina. We really appreciate your insights, and we're going to jump to the next speaker, but we'll have you back in a few minutes at the end for a Q&A.
Okay, sounds good. Thanks, Sebastian.
See you soon. Now, I would like to invite Andrea to the stage. Andrea Wetter has a degree in business administration from the Universidad St. Gallen in Switzerland, in addition to specialization in entrepreneurship from the Stanford University Business School in California, United States. Wetter has worked at companies such as Incid Investimentos, where he was a venture capital manager, and BTG Pactual as an investment banking analyst. Andrea is A55's co-founder and president. A55 is a fintech that provides access to capital for technology-based companies with recurring revenues. In total, its business has generated more than 200 million reais in credit in both Mexico and Brazil, boosted more than 200 companies, and has more than 14,000 registered entrepreneurs. Andrea, it's a pleasure to welcome you. Please tell us a little bit more about A55 and your journey.
Thanks, Sebastian. Thanks, SeedStars, for having us here. And we are glad to explain a bit about our business model, what we do, and relate a bit to venture debt operations. So we are a growth lender for technology companies, and mostly we lend to businesses which have recurring revenues. So we really like any kind of technology businesses which have a subscription model. And we're mainly focused in SaaS businesses, but we also do anything as a service or things which have recurring contracts. And it doesn't have to be a venture-backed company. So we work a lot with bootstrap also companies. And we have a business model which mostly tries to understand the unit economics and the financial traction of those companies to lend to those companies. So it doesn't have to be a company which is raising a round or it's going through a venture capital structure, as long as it has good traction, exponential growth, and a business which has good unit economics, low churn. So we really like technology businesses with high margins and that are growing. So we are the first fintech which is really focused on Latin America, and we are now in São Paulo, in Brazil, and also in Mexico City. And we're doing loans in Mexico and in Brazil. And mostly we finance companies that are asset light. So usually they don't have access to traditional banking lines because they don't have any assets to pledge. And companies which are mostly in an early stage of growth. So really companies which just started, chill companies which are maybe at $1 million in revenues. So the way we do this is we use data, and we have a platform where the company connects their data points, which are usually banking accounts, acquirers, and other kinds of data where we can gather information and do a business analysis. So the whole process is digital through a platform that we offer those clients. And that platform also has several BI and components where we help actually the company founders to understand a bit about their unit economics, how their traction is, and how that compares to their business sector. So when compared to, for example, venture debt, we are focused on solutions which don't need really an investor, but we are glad to really work with venture-backable companies. And right now we offer two different kinds of business lines. So credit lines for companies with recurring revenues, where we mostly leverage their MRR. So we leverage their MRR up to 6 times. And it's a business line where we grow together with the company. So the idea here is that we can loan to a company, and as it gains traction and grow, we grow that business line together. So they have really working capital to work on their customer acquisition costs, marketing, sales, and so that they can grow exponentially without having a problem that usually, any recurring business has, which is as you grow, you usually need more working capital, because as you raise the subscriptions, you have to start investing more and more to finance your customer acquisition costs. So what we like are companies which have really a good return on their customer acquisition costs, meaning that they have a good LTV to CAC, and companies which usually recover their CAC in less than 6 months. So we mostly finance that growth through those credit lines. And when related maybe to a venture debt operation, I think the biggest difference is we don't see if the company is doing an institutional round, or if they have an exit strategy, or if they are able to raise additional funds. We are glad to actually participate in rounds, and we've been doing that for a while now, where we give non-dilutive capital to the company together with let's say a Series A or a seed round. But mostly companies which try to get our line, our MRR line. There are companies with traction which are trying to just finance their working capital operations. And usually they do that to extend also the runway, or to actually boost and leverage their sales and grow even further. And we also began doing performance-based loans. I'll quickly explain what that is. So that's mostly targeted right now in Brazil for e-commerce. And what we do is, instead of having a traditional loan where we have, installments which are fixed, we try to monitor the company's revenues. And whenever the company's revenues go up or down, our installments go together with them. So usually we take 1 to 25% of those companies' revenues to be able to amortize that business line. And what happens is, whenever those companies have a seasonality, we are able to actually lower the installments fees so that they don't have a problem actually paying us back the business line. And it doesn't have a maturity which is set. So for example, a company can loan, let's say $100,000, and it will pay us back by, giving us 10% or 15% of their revenues till they're able to pay that back. So that's really good for businesses which are growing quickly, but they have a high seasonality. And the MRR lines that we offer are mostly good for businesses which have really recurring revenues and which are growing, and then they also need working capital as they grow. So when compared to mostly solutions which are given to venture-backed companies, we do not really see if they have a good investor, or if they are doing more equity rounds or such. We just try to see their financial traction, and we monitor that through the platform that we offer those clients. And as they grow, since we are plugged into their revenues, we know that they're growing, and usually we offer new business lines or a top up on their initial investment. So the idea here is that we give them capital to grow. And if it's a bootstrap company, it can, as long as it has positive unit economics and is generating cash and it has a decent enough runway, we're happy to actually support them on that growth and give them additional business lines. Speaking about also the e-commerce operations that we offer, mostly that is given to direct-to-consumer companies. So companies which they have their own e-commerce platforms and which are trying to get a consumer base. So we're trying to help them on their marketing structure as well. So trying to see if they have a good return on their investments and trying to boost that. So if they have good ad returns, so if they have a ROAS of 4 or more, usually we're happy to support them on that growth as well. So you can pass on the slide, Sebastian. Yeah. And I'll give here also an example about an MRR business line that we have in Mexico. So we are both in Brazil and Mexico. The countries have a bit of difference. So the business lines in Brazil and Mexico, they change a bit due to the structure that the Mexico financial system or the Brazilian financial system has. But in Mexico, for example, we are happy to give companies up to 5 million pesos. And we usually leverage those companies up to 6 times their MRR. So a company which has, let's say, $100,000 in recurring revenue, it can get up to $600,000 from us. And as they grow, we usually leverage that. So if in the next month they have an additional $10,000 in MRR, we can also give them an additional $60,000 as a line. We usually see companies which at least has 6 months of proven track record, meaning that, for example, in Mexico, they have to have 500,000 pesos of gross revenues in average, and then they can grow from there. And our rates in Mexico are around from 26 to 32% a year. That changes in Brazil, and usually the term is 12 to 24 months. So that's really tied to usually what the ACV or the contract for a SaaS company is. Usually those are 12 or 24 months. So we are happy to finance them through that. But of course, as the company grows, what we do is we actually have a model which is recurring. So if the company is growing, it can get additional business lines. So actually, we roll over the operation as the company has good and positive unit economics. And it's specific for, of course, subscription and recurring revenue companies. And I think the biggest point here is that really the company has a efficient capital usage. So instead of raising, let's say, a big equity round or a big, loan that they will use for the next 2 years, the company can really see what they need in terms of working capital operations. They can get that from us. And as they need additional working capital, we are happy to give them additional lines. So they don't have to pay, for example, interest rates for a bigger loan than they might need at a time. So they can really draw the capital as they need. And it doesn't affect the company credit scores. So it's not like a traditional credit where usually if you get your first and then your second business line, you can see that the company leverage is going up. And usually those lines are going to cost more if you go through the traditional banking. It's actually quite the opposite as we do. As the company grows and gets better positive unit economics, we are happy also to lend at lower rates and give them additional leverage if they need to. And I think the biggest point here, especially for Latin America, where we are positioned, is it doesn't need any warranties. So we don't use, for example, the company cash flow. They don't have to give us receivables or fixed assets to get their loan, as long as they have that positive unit economics and tractions. It doesn't need any investors, so we don't discuss valuation. There is no kicker to the operation, so it's fully non-dilutive, and it can work also as a boost to an equity round. So we're doing that a lot with seed and Series A players. We partner up with different venture capital companies, and as they are doing, for example, a new round, we are happy to follow with that. So we have a specific also product where we give them also a bigger term to be able to pay us back, since they just got a new equity round, and they usually get a better term in terms of the interest rates. So the interest rates are lower if you're getting an MRR line together with an equity round. We partner up with most of the Brazilian venture capital firms, and we're doing that in Mexico as well. But right now, if you see our portfolio, is really a mix of bootstrap and venture-backed companies, and I'd say it's 50-50. Mostly we back up SaaS companies, but we are really happy to back up also, let's say, hardware as a service companies, education companies, law tech, and other businesses. And we are expanding through Latin America slowly. So here in the picture, you can see the offices, the regional offices that we have. And we are also seeking to, for example, expand to Colombia within next year. And so because we see that through Latin America, you really have kind of the same pains when it comes to raising debt for technology companies. So traditional banking doesn't really lend to companies which are burning, money and are going through rounds. And whenever it goes to bootstrap companies, usually they try to get guarantees. And the problem is, of course, those asset-light companies usually don't have those. So we're taking on companies which are usually not seen or not really care about traditional banking, and giving them those loans so they can grow. So really the working capital operations that we do are mostly to finance customer acquisition costs. And we do sometimes finance CapEx, as long as the company really knows kind of how the return of that investment is coming. So we really like to finance companies which the use of capital is known, and they know that can give them return on capital. So if they're launching, let's say, a new product, or if they're launching something which is where the returns are uncertain, then usually it's something we are not backing up. But as long as they're investing in something where there is some return on capital which is known, then we're happy to finance them as well. And whenever it is for, working capital, so financing their marketing team, sales organization, or so on, we are happy to back that up. And then we try also to invest in companies which are growing at least 20% a year, because we think it makes sense from actually the cost of capital, so that they finance their growth with us. Right now, we just lent to 400 companies. So Sebastian, kind of the data that you have is kind of in the past. So right now we just lended to 400 companies. Awesome. And we did about $70 million in loans to those companies.
Fantastic. Well, congratulations. The more the merrier, right? So exactly. Maybe before we move over to our Q&A session, can you tell us a little bit more? You talked about the difference to lending to these high growth technology startups versus maybe a traditional business. But can you tell us a little bit more how A55, being a technology driven lender, has allowed you to really effectively service this type of clients?
Yeah, sure. So we like to lend to technology players mostly because they have a really scalable business, and usually the digital businesses they don't need to build new, let's say, brick and mortar places, or they can spend quickly. And the reason we mostly lend to those companies which have recurring revenue is because they have a projected cash flow which is known. So we are happy to lend to those companies because since they have stable cash flows and they don't have any assets, then we have a higher warranty. They are able to pay us back, or they are able to outgrow their current cash burn, and then they can pay us back. And lending to traditional companies, then what usually we see is if they have positive EBITDA, or if they have good enough traction, so that whenever they are doing a new project and they need to burn cash, we know they're able to then make EBITDA and make cash and pay us back those loans. So when we're looking to more traditional venture-backed companies, then what we're looking for is companies which are growing, and they're able to raise additional capital, of course, but companies which have good unit economics. And we know that if they have to turn and make positive EBITDA, so they're able to pay us back those lines, they're able to. So companies that, even though they have a cash burn, we know that they can cut that and still make money if they want to. So we're mostly looking to traction data and banking data to be able to do our loans. And we don't really need to understand who is behind the operation, or if the operation has, let's say, a good venture capital thesis, because of course some companies are more venture backable and others are more traditional, or they have low or they have low multiples, and therefore it's easier for them to grow using debt than actually getting venture capital. As we said, it's expensive and dilutive, so they like to actually finance their growth with debt because they have low multiples on their venture capital equity rounds.
Fantastic. Thank you so much. With that in mind, I just want to thank you for your insights, and I would love to give the opportunity to the audience to ask some questions as well. So Gina, could you rejoin me on the stage, and we'll have a very open discussion, very casual. So if anyone in the audience has questions, please do reach out. And maybe to start, we have a question in the chat. Talking about what are some of the common challenges that founders face when raising their venture debt or these monthly recurring type of it. So I don't know if either of you wants to speak a little bit about that.
Sure. I can go first. No, I think maybe this is definitely one of the part of our job, right? Which is to really educate the market. So it is a new instrument. It's different from how equity works. So there needs to be more, education materials, webinars like this one, to really give more context and to be able to explain better, what are the terms that make venture debt what it is, and how do you really think about layering debt together with equity raises? How do you time it? How does that fit with your overall fundraising strategy, with your need for capital for various things operationally? So I think these are the things that we would love to work with our entrepreneurs on. And I think one of the things that maybe one thing that I would avoid if I were a founder is, as I mentioned, waiting until you absolutely need the capital. Because we do require that you need about 12 months of cash runway at the time of funding. So just make sure that you actually have ongoing conversations with funders with enough, headway.
Awesome. That makes total sense. And maybe we have another question from the audience, from Martin Johnson this time. He's asking, how about do these type of instruments cover lending against future cash inflows, or should he be looking at a different type of instrument?
Maybe I can answer that one. That's a great question. So usually venture debt is tied to companies which are raising equity capital and have institutional investors, right? But you do have, for example, in more mature markets, lots of solutions which are alternative lending to companies like MR lines and revenue-based loans. So we began doing that in Latin America, and those, it depends. We have operations which are backed up by the company's cash flows. So the MR line, it can be backed up by the company cash flows. And what happens is, if we do that, if we have the receivables as warranties, we actually lower the interest rates of those loans, and we can give bigger terms, so the terms have bigger maturity for those companies. And on the revenue-based investment part, so companies which doesn't really have recurring revenues and have seasonalities, but they are growing, we actually use those cash flows to be able to pay us back that line. So like I said, we usually take, for example, from 1 to 25% of the company's revenues to be able to amortize that loan. So what we do is revenue split, and then we use those revenues to be able to amortize the loan. So it's something quite, I think, new globally, but you do have options which are for companies which are bootstrap and doesn't have any institutional investors. I'd say, and Gina can complement me on that one, but that venture debt corporations usually try to seek companies which are raising future rounds or already raised institutional capital.
That's right. Yeah, I think, Andre, you're right in saying that venture debt, typically the way things are structured currently, it's really available for venture-backed companies. But we are also looking to expand how we can support non-venture-backed companies to sort of expand our offering, maybe through revenue-based financing or some other options. But that's down the line. Yeah.
Fantastic. No, and I think that's the spirit of these webinar series. We actually talked about revenue financing a couple of weeks back. So yeah, I think it's important to put all these type of products on the table. Just to learn us a little bit of more of a practical question. He's asking, what happens in the event of a default? Obviously, you guys are working with high risk tech companies. Is equity used as a cover or as a collateral in these cases?
I can go first.
Yeah.
It's a really interesting question. Actually, surprisingly, even though we are working with really early stage companies, the rate of default historically for venture debt has been very low. Historically, if you analyze sort of the portfolio and non-accruals for what's called the business development companies, which are a lot of venture lenders in the US are actually incorporated in this way, and it's the information is publicly available. So when we had a look through, what the default rates were, because we are working with venture-backed companies. Our tenor is usually between 24 to 36 months. The likelihood and the probability that our portfolios will actually go into bankruptcy within the tenor of our loan is especially low, especially if you're actually backed by top-tier VCs. So I think the rate of default is actually surprisingly low. We have 2 to 3% default, which is quite low, which is surprising, right?
Yeah.
But if it does happen, there are different things that we will do. So as you can imagine, we do monitor the performance of portfolios and how you're actually meeting your obligations. We do have a risk scale that's about 8 different scores. So it's really updated based on different informations and the reports that we receive. But when the loan actually becomes delinquent or non-accrual, it's different definitions of how late you are. I think what we do encourage companies is to really just talk to us as early as possible. If you foresee something happening, talk to us, so we can actually work together. Because our preferred option would be to sort of help you restructure the loan so that, it could be, I guess, equity cover, sort of like, changing the warrant options that we have is definitely one of the ways that we can work on it. There will be other ways to sort of convert the interest to more of a PIK loan. So it's a payment in kind. So you can kind of accrue the interest for a little bit just until you actually come out of this. And then you're able to start making payments on the interest. So I think there are different ways that we can work together to really mitigate defaults. So yeah, please, I guess, when we do work with companies, we always encourage them to just keep constant communication with us. I hope that answers the question.
Yeah, it certainly does. And thank you so much. And I love that you highlight that aspect of really being in communication, right? I think, especially raising from a fund, it's very much about having that relationship and fostering it, not only on the good times, of course, that's important, but also when things get a little bit harder. Maybe this is a question for both of you. Given that you work with a lot of different companies, what are some common challenges that these borrowers typically face in your process that might not, make them able to really finalize that loan?
Uh-huh.
Hmm.
So again, I think that's especially for you. But I'd say, at least for us, the difficulty that founders challenge to raise debt is usually they, at least we really try to see the financial traction of those companies.
Mm-hmm.
So we have a bunch of filters and ratios that we use to be able to actually launch a company. So it really depends on having good traction companies with good unit economics, high LTV to CAC. So we try to see that, and before raising with us, I think the company has to know why it's using the capital for. So if it's using for working capital operations and to grow something that they know, they see how the capital can be invested to generate additional revenue, that's okay with us. But if it's a project that it has something which is uncertain, then usually we are not the best option for those companies.
Yeah. And I think I already elaborated on this a little bit before, but it's really making sure that you do fit the criteria that we look for in terms of the investment considerations, what kind of business model you have, and also in terms of your funding requirement. Have you actually worked with institutional investors before? So I think these are the things that are sort of the prerequisites, requirement of raising venture debt. But actually, once we start the conversations, we sort of start getting to know each other, and also kick off the due diligence. I think, as I mentioned, it's a pretty straightforward process. We do sort of leverage a lot of the material that you already put together for your equity raises. So I think we will definitely be there to really guide the entrepreneurs through the different terms. Receiving a credit agreement may be quite daunting at first. So we'll try to come up with different guides to really help you understand the various terms and sort of the more financial, technical terms that relates to debt. So that's sort of what I would say about this. Yeah.
Fantastic. No, I think it's super useful. And I completely agree, right? Like you gotta know whether you fit the criteria, but make sure you have all the documents to support that, and you're organizing the process. Uh, Maybe a little bit of a more high level question. I think you both spoke about increasing the size of these debt allocations and kind of increasingly working with these companies. How important is for companies to use venture debt as a way to create a track record that they can actually get loans and potentially in the future access other types of financing?
For venture debt in particular, I think you don't necessarily need a track record of raising debt because we typically are the first lender. So it's not necessarily to do with that, but the track record will be more just your business milestones and also your funding history. Whether you've worked with institutional investors before, as I mentioned. So I think it would be those types of track record, but not necessarily specific to debt.
And maybe as for do you see companies as, for example, you're the first lender, then being able to go forward and raise other types of financing as well here in the loan space?
Yeah, no, so I think it really depends on what kind of debt that you end up raising, right? As I mentioned before, there is definitely a healthy range of, how much leverage or debt you should take on, depending on your equity and other assets. But I think in terms of just thinking about I guess raising from other financiers or lenders down the line, absolutely. I think there will definitely come a time where I think I think the company will become too big for us, right? So I think we'll also definitely help work together with the other lenders to make sure that it's a continued financing and a long-term partner that you have in us.
Fantastic. Yeah, Andrew, what about you? Do you see these companies leveraging the track record you give them to raise financing afterwards?
Definitely. So we are also, like, we are usually the first lender for those companies. So at least the first debt operation. So a lot of those entrepreneurs have never really raised that before. But going through our process, actually, so we had that as a feedback, actually helps them understanding how they work with that. And it helped them also raise equity capital and, for example, venture debt in the future. So we start with companies which sometimes are at the time bootstrap, and then they raise their first seed round and so forth, and then they get a venture debt when they get bigger. So we are usually also the first lenders. But going through the process that we have and through the analysis, it actually works like it's not a certificate, but they can show that to a venture capital firm which partners with us, and they know how our process works. So it's an additional validation for those companies. And whenever they're raising venture debt, I think at least in Latin America, venture debt is really early on, as in Asia, right? And for example, in Brazil, we have 8 venture debt lenders, and we all know each other.
Yeah.
So usually when the company gets up to our maximum limit and they have to get additional capital and they are venture backable companies, we are giving them, so we are bridging them to those venture capital firms, which usually do bigger and larger tickets. So it helps them to validate that they're able to raise debt and are able to pay us back.
Awesome. Well, thank you very much to both of you. With this last question, we conclude our Q&A section with our speakers. However, before we say goodbye, I wanted to highlight two things. The first is that just like Abound and A55 are doing fantastic work in Asia and Latam, respectively, there are other investors to consider. I think a person in the chat was asking about potential debt providers in Africa. We have people like Equalife. So definitely, as a founder, do your research of who's lending in your region. It is a relatively new instrument, but one that is growing quite fast, and it's very exciting. And the second thing I wanted to highlight is that we will have next week the 7th and final installment of our webinar series. We'll be talking about impact-linked financing for technology startups. So if you have a company with a social or environmental impact or mission, definitely tune in next week to chat about this innovative tool for entrepreneurs. Gina, Andrea, thank you very much for joining us. Your insights have been tremendously helpful, and I'm sure the entrepreneurs in the audience will make good use of them. Everyone in the audience, thank you very much for joining, and hope you have a great rest of your morning or afternoon or night.
Thank you, everyone.
Thanks, everyone.